QuickBooks Pro Desktop 2021. Multiple currencies, accounts payable, adjusting entry. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You could open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we entered a bill for the purchase of inventory, increasing the accounts payable. We had that bill that we're going to pay in the future, not in our currency, US dollars, but in a foreign currency. So at this point in time, we want to enter an adjusting entry as of the end of the time period when there's going to be a different spot rate or exchange rate. So let's take a look at what we have by going to the reports dropdown, company and financial, and take a look at the balance sheet standard. Balance sheet standard, changing the dates up top in the customized reports from 01/01/21 to 12/31/21, and then OK. So we have up top, well, let's go down to our accounts payable. We now have the accounts payable on the books at the $33,000. We have the inventory on the books at the $33,000. Now we put this on the books. If I double click on this, the transaction happened on 11/16. We're going to say now it's the end of the year. We want to make our financial statements, but we need to then revalue this because that $33,000 represents our currency's valuation of what we're going to owe in foreign currency as of the date that we made the purchase, and we need to change it and update it to the current period's date. So, and note, if I go back to the home page, remember that we have these two components with the paying of the bills. One, we enter the bills, and that means that's what we did last time. We entered the bill, we put it on the books using the current spot rate, and then typically we would simply pay the bill, which we could do in QuickBooks, and QuickBooks will help us to basically record the difference, the gain or loss at the point in time we pay the bill. But we might have that situation in the middle where we have a cutoff date, say the end of the year, for example, like in this example, and we might need to adjust our financials to that point in the middle of the year. And in that case, we would have 3 dates that would be involved that we would need to deal with. The date we entered the bill, the end of the year that we need to make right as of the cutoff date, and then the point after that we're going to actually pay the bill. So the way we will deal with this is we're going to enter the adjusting entry as of the end of the year, then we'll reverse it as of the beginning of the next year, and then we'll be back to our 2 date ranges, and then when we pay the bill, everything should work out at that point. So this will be a couple step process. Right now we're just going to be doing the adjusting entry. Let's think first about how it would look in Excel, just looking at journal entries. So, for example, if we have this on the books at this point in time, we're going to say there's our accounts payable at the $33,000. We need to adjust it to what the US dollar equivalent would be that we're going to pay in foreign currency in the future, but as of today's spot date, today's exchange rate. So we're going to say, all right, that means that as 12/31, the exchange rate is going to be this right here. So that's going to be the current exchange rate. So we're going to say, let's pull out the trusty calculator, and we will then be paying the amount of the 20,000 pounds. So 20,000 times the December, which is 1.63. That's going to give us the 32,000. So what we have on the books now is the 31,000 in the accounts payable. So we have a difference. We're going to lower it by 32,006 minus the 33,000. So we're going to lower it by the $400. So that means that we're going to have to debit the accounts payable. We're actually kind of decreasing the accounts payable, which is kind of good, right? We're kind of decreasing the accounts payable. Let's think about, which way the currencies are going, because it can be kind of confusing to think about which way the currency goes and is that good or bad. So notice we're talking about 1 pound here, British pound. And if we're thinking before it was 1 pound could get 1.65 US dollars. Now, 1 pound could get 1.63 US dollars, meaning the pound got weaker in compared to the dollar. 1 pound can get less dollar equivalents at this point in time. And we're talking about something that we're going to be paying in pounds. So the fact that it got weaker and we're paying in that currency, and we've already committed to pay in the currency, and now it's weaker compared to the dollar, is good in our situation at this point. So we're going to say, all right, then that means that we're going to be debiting. Let's do it this way. We're going to be debiting the accounts payable. So accounts payable is going to be a debit. And I'll do the calculation again. We could do the calculation this way. This could be equal to, I'm going to put brackets around the larger number minus the smaller number of the two exchange rates, so it becomes a positive number, times the 20,000. And there's our 400. That's going to be the debit and the credit. The credit then is not going to be going to the inventory. We're not going to adjust the inventory, even though we're paying for basically inventory. What we're going to do instead is record the gain or loss for the exchange transaction. So it's going to go down here, foreign currency transaction gain or loss. So we're going to be putting it there. And note that this is why it's kind of important that we're putting it down here, because this is a cut-off transaction. These are temporary accounts that will then roll into the retained earnings. So when we do this in QuickBooks, we want to make sure that we get it in the right year, right? The income needs to be reported in the right period. And we'll do that with our adjusting entry and our reversing entry. So let's go ahead and record it now. So we're going to go then to the accounts payable. If I double click on the accounts payable, I'm going to say plus. We'll pick up the 400. The accounts payable is now at the 32,600. That 32,600 should match the current rate, which would be the 20,000 that we're going to pay in pounds times the 1.63 rate. So there's the 32.6. So that looks correct. And then we're going to put the other side, which is going to be a gain in this case, into our gain side. So I'm going to double click on this transaction plus, pick up that 400, and there is our transaction in terms of journal entries. So now let's enter it into QuickBooks and see how we would do that in QuickBooks. So we can use the nice little feature within QuickBooks to do this transaction. We would go to the lists dropdown. We want to go to the currency lists. And then I want to make sure that I have the current currencies for the current date. If I was working in real time, I would go to the activities, the rise up, and then I would be going to the download the latest exchange rates right there. But because we're in a practice problem, I'm going to manually input these items. So I'm going to double click on the British pound sterling. And then we're going to say this is as of 12/31. So I'm going to say 12/31/21. The rate then will be, what did we say the rate was again? It was 1.63. 1.63. That's what we said it was. I remember now that I looked at it. Okay, and so then I'm going to say okay. And then I can get the system to do the journal entry for us by going to the activities. And then I'm going to say, I want you to download the latest adjustment, home currency adjustment, the top one. And we want to do it as of 12/31/21. We want to do it for the GBP, or the British pound sterling. And there's the current rate, 1.63. That looks correct. So we're going to say calculate it. And then it's going to pick up the items that are in that currency unit that could need calculating. That's the one we want. 20,000, that's how much we're going to pay in the foreign currency. The balance was 33,000. New balance at the new rate is going to be 32,006. These are the US dollar equivalents on the two exchange dates that we're talking about, the two spot rates, the two different dates are involved to pay the 20,000 units of the foreign currency. And that means that we're going to have this change of the $400. We're going to say save that. I don't need a new one. Just save and close. Save and close it. And let's go and check out what happened and see if it agrees with what we did in Excel. I'm confident it will. I feel pretty good about it. So I'm going to go to the balance sheet, back to the balance sheet. We're in the accounts payable, double clicking on the accounts payable. There's the 400, and it's a journal entry type of transaction. And it made our amount at the 32.6. I think that's what happened in Excel. So is that what happened in Excel? Suspense. Yes. And relief. All right, now we're going to go to the income statement or profit and loss reports dropdown, company and financial. We're going to go to the profit and loss standard, changing the dates from 01/01/21 to 12/31/21. And then there we have our gain loss on the 860. There's the 400 that has been included in it. These two are combined. We broke them out in separate two accounts for the gain and loss over here. The difference between the two being that 860 that we find in QuickBooks now. So now what we have here then on the income statement is the correct basically change or gain related to the foreign currency transaction. And that's as of the cutoff date, which is going to be December 31st. So it's included in, this year. So what's going to happen next time is we're going to go into next year, and we haven't yet received or paid the bill. So if I go back to the home page, then we're going to have to pay it we're going to pay it in the next year, right? So that means that we're going to have another date, because when we pay it, we're going to have another exchange rate at that point. So, and when I pay the bill in QuickBooks, it usually does the calculation of the gain or loss for us at that point in time. But the problem is, part of the gain or loss calculation between these two dates needs to be in the current period, and part of it needs to be in the following period, as we've talked about in the prior presentations, but this one's a little bit more clear because we'll actually make the payment after the cutoff in this one. So what we'll do then is we'll reverse what we just did so that it will be recorded in this period. We'll reverse it in January, and then when we record the pay bill, it'll net everything out, and we'll have the proper amount of the gain or loss reported in the proper time periods, one in the prior year, one in the current year. You only really need to do this if you have that cutoff period that happens possibly the end of the year or the end of the month, where you need to basically generate the financial statements. So we'll continue with that next time.